Welcome to episode 5 of the new Barbarians AI Agent podcast. Today, our two AI generated hosts discuss my SSRN paper, Navigating the New Macro Landscape Systematic Approaches to Alpha Generation in an Era of Geopolitical Uncertainty. Today's discussion focuses on quantitative macro investing strategies designed for our current complex market environment. We'll examine the distinctive twist steepening yield curve regime defining Q2 2025 and evolving US-China trade dynamics. Our hosts will explore how systematic and discretionary macro approaches can be integrated for enhanced alpha generation, diving into how macroeconomic variables like inflation, production, and credit factors contain unique predictive power for individual stock returns. Based on our replication of recent research on sector macro relationships, we'll provide specific guidance for the current twist steepening environment. Expect cyclical sectors like energy, materials, and large banks to outperform, while interest-sensitive sectors like utilities and real estate may underperform. The conversation will cover advanced techniques, including machine learning applications for regime detection, alternative data sources for macro signals, and cross-asset relative value strategies. This episode offers quantitative researchers and investors actionable frameworks for developing systematic macro strategies in today's dynamic landscape. Ready to explore the research yourself? Our freely available Google Colab Jupyter notebook for replicating the sector performance analysis is linked in the description below. Welcome to the new Barbarians Podcast. I'm Bill Mann.
And I'm Mark Connors. We're here to deliver insights on how current market events impact the traditional investment portfolios of stocks and bonds that Bill and I traded on Wall Street. Today, we see digital assets as the next frontier for finance and investment.
We're also here to explain how cutting-edge tools like AI and disruptive tech are the new barbarians at the TradFi gate.
So instead of Mike Milliken's innovation on debt financing with junk bonds, today's barbarians at the gate are changing the landscape almost daily across regulation, legislation, and finance.
So hit the subscribe button and let's cut through the noise together.
Welcome to a deep dive into the pretty powerful world of systematic global macro investing.
It's great to be here.
We've got a really interesting set of sources today. They really pull back the curtain on how investors navigate these incredibly complex economic and, political landscapes.
That's right. Across a huge range of assets, too.
And it's all about making decisions based on the big picture, isn't it? Global trends, central banks, geopolitics.
Exactly. And the sources really highlight a key difference, the gap between, let's say, the traditional discretionary approach, which often relies on gut feeling.
Right, intuition.
And these rule-based, data-heavy systematic strategies we're focusing on.
So our mission today is to explore these sources, understand how these systematic methods try to generate alpha, those returns above the market benchmark.
And we'll look at how this applies right now, especially with some interesting things happening like this twist steepening in the yield curve, and maybe some easing in US-China trade tensions.
Yeah, that's a fascinating mix. And this stuff touches everything, right? Stocks, bonds, currencies.
Oh, yeah, commodities, derivatives. It's properly global, properly macro.
Okay, let's start at the beginning then. Fundamentally, what is global macro investing trying to do?
Think of it like having a satellite view of the whole world's economy and political scene.
Okay.
You're looking at big events, inflation numbers, interest rate decisions, policy changes, geopolitical shifts.
All the major headlines?
Exactly. And trying to figure out how those are going to ripple through and affect asset prices everywhere. It's very top-down. Get the big picture, then decide where to invest.
So you're not necessarily digging into, one company's earnings report?
Generally, no. It's more about the wider economic currents. And that means you can invest across that whole broad range of assets we mentioned.
Right. And historically, this was kind of the realm of legendary traders using their experience, their intuition.
Yeah, the discretionary legends. But the sources really emphasize this big shift towards systematic methods.
And this is where the rules come in. The quantitative models, the algorithms crunching historical data.
Precisely. You build models based on past data, on economic theory, set up clear rules for buying and selling, and then, you let the system run.
Which sounds very different from the discretionary style, which is more subjective.
Much more.
Mhm.
More qualitative analysis,
Yeah.
judgment calls. Systematic is about trying to make it more scientific, more repeatable.
So why the big move towards systematic? What's driving it?
Well, technology, for one.
Mm-hmm.
And just the sheer amount of data available now, it's a game changer.
Makes sense.
And the advantages are pretty clear. Systematic approaches can chew through massive data sets way faster than any human team could.
Right.
They help reduce those behavioral biases, getting too fearful or too greedy,
Right.
which can really hurt a discretionary trader.
Yeah, okay.
They can potentially spot subtle patterns, relationships in the data you might just miss otherwise.
And testing, I imagine that's a big part of it.
Absolutely. A huge advantage is having a rigorous framework to backtest ideas to see if they actually would have worked historically. It brings discipline, consistency.
But reading through the sources, it doesn't sound like the discretionary approach is dead, is it? There are still times when that human judgment seems critical.
Oh, definitely not dead. For genuinely unprecedented events, things where history isn't a good guide. Or for really nuanced geopolitical calls, discretionary managers can be much more flexible.
They can adapt faster, maybe?
Potentially, yeah. They might spot a major shift, a regime change, before the data fully confirms it, or navigate a sudden crisis with quick, dynamic decisions that a rigid system might struggle with. So, both have their place.
Okay, so if you're building one of these systematic engines, you need some serious tools. The sources talk about macroeconomic modeling.
Yeah, the models provide the kind of theoretical foundation. They help you understand why economies move the way they do, and how that should, in theory, connect to asset prices.
Like fundamental relationships.
Exactly. Things like, the real business cycle framework, though. Interestingly, one source mentions combining these now with things like deep reinforcement learning, which is pretty cutting-edge stuff.
Yeah.
Or models central banks use for stress testing. They give you the underlying economic dynamics.
And then to actually work with the data, make forecasts, you lean on econometric tools.
Yes, those are often the workhorses. Linear econometric models are really foundational for quantitative macro.
Like what sort of models?
Well, you might use something like ARIMA for forecasting inflation or GDP. GRCH models are really important for understanding volatility in markets, crucial for risk.
Right, volatility clustering.
Exactly. Then you have things like VAR models to see how multiple economic series influence each other, and cointegration to find long-term relationships between assets or indicators.
Sounds powerful, but I bet it's tricky to use in the real world.
Cool.
The sources definitely flag some challenges.
Oh, absolutely. Applying these isn't straightforward. You need point-in-time data. That's critical.
Meaning data as it was known at that time.
Precisely. No using revised data that wasn't available back then. That leads to look-ahead bias. Makes your backtest look way too good.
Got it. What else?
Dealing with data released at different frequencies, some monthly, some quarterly. Relationships can change depending on the economic regime you're in.
So what worked in a boom might not work in a bust.
Exactly. And sometimes the fundamental structure of the economy changes, and old patterns just break down completely. Structural breaks, they call them.
And connecting this to practice, one source shared a replication of some recent research, right? Looking at macro variables and sector performance using linear regression.
Yeah, that was a great example. You used a relatively simple tool, linear regression, to quantify how sensitive different stock market sectors are to various macro factors.
Yeah, interest rates or inflation.
Yeah, exactly. They even set criteria for what counts as a strong relationship based on the stats, like R-squared. Now, linear models, their simplification, they won't catch every complex, nonlinear thing.
Yeah.
But the study showed they could still give you a solid, quantifiable way to understand these basic macro to sector links. A good starting point.
Okay, so you've got the big economic theories, the statistical tools for analysis. How does this all translate into building an actual investment portfolio?
Right. This is where asset allocation comes in, heavily guided by that macro view. Research clearly shows that the best mix of assets changes depending on where you are in the economic cycle.
Contraction, recovery, expansion, slowdown.
Yeah.
Those phases.
Exactly. What works in a recovery might be terrible in a slowdown. Your strategy needs to adapt to the economic weather.
And there's this idea of macro factor mimicking portfolios mentioned in some recent work.
Yeah, that's a cool concept. Instead of just allocating between stocks and bonds, you try to build portfolios that directly capture exposure to fundamental macro factors like growth or inflation.
Across different asset classes.
Yes, across assets and even investment styles. It's a different way to think about exposure.
which links nicely into factor investing itself. We hear a lot about value, momentum, carry. Do these standard factors fit in?
Oh, absolutely. Plenty of research shows these classic factors work across stocks, bonds, currencies, commodities. They're a key part of many systematic strategies.
And this seems crucial from the sources. It's not like these factors work all the time, is it?
No, not at all. And that's the critical link back to macro. Factor performance is highly dependent on the economic regime.
Oh,
You can't just blindly follow a factor strategy. You need the macro context to understand when it's likely to pay off and why.
And some newer research is trying to integrate these macro and style factors more directly. How does that study linking macro and sectors fit in here?
Well, that study gives you a kind of map. If it shows, for instance, that financial stocks are really sensitive to the yield curve steepening,
Right.
and you also know that value strategies often hold a lot of financials, then you can see how a macro event, the curve steepening, might directly boost your value factor exposure through that channel. It helps connect the dots.
That makes sense. And that study replication had another finding that jumped out at me. These links between macro and sectors get stronger when things are really volatile.
Yes, that was a key insight. When macro variables make big moves, like more than one standard deviation away from their average,
Big shocks.
right, the sensitivity, the correlation between those macro shocks and how sectors perform actually gets stronger. It intensifies.
So the relationship matters most when things are moving significantly.
Exactly, like the underlying connection gets amplified during those periods of change. You can see it visually in the results. The R-squared values measuring the strength of the relationship were higher during those shock periods.
Interesting. Okay, moving beyond these core models and factors, the sources mention some more advanced techniques popping up.
Yeah, the field doesn't stand still. People are applying AI and machine learning. We mentioned deep reinforcement learning being used in macro models. Other research uses ML to try and predict fund manager skill, which is fascinating.
Wow. And what about looking at investor behavior itself, how markets process news?
Yes, there's research digging into that too. Like, how do investors learn and react? Is it purely based on economic models or more trial and error? Understanding these behavioral quirks can potentially open up new strategies.
Such as?
Well, if you spot systematic biases in how investors react to, say, earnings announcements, maybe you can time trades better, or exploit predictable seasonal patterns that seem behavioral, or even just track where investor attention is focused, as that can shift market dynamics. It adds another layer.
Okay, so we have the theory, the tools, the factors, the regimes, even investor behavior. How do you put it all together to build a portfolio and, crucially, manage the risks?
Diversification is job number one. Really broad diversification.
Across asset classes.
Yes, stocks, bonds, currencies, commodities, and across different countries and regions. The key is that these different macro assets often don't move together. Their correlations can be quite low, especially when markets are stressed.
Like bonds going up when stocks go down.
That's the classic example. Government bonds or certain currencies can act as safe havens during equity sell-offs. So diversification isn't just about smoothing returns. It's about how different assets react to big macro events.
And you don't just hope correlations stay low, you actively manage risk.
Absolutely.
Yeah.
Active hedging is common, using things like options or futures contracts to specifically protect against certain risks, maybe currency fluctuations, interest rate moves, or just broad market downturns.
So diversify widely using low correlation assets, spread bets geographically, and use targeted hedges. How do the quantitative models help decide how much goes where?
The models are key for the actual allocation. You might use them for strategic allocation, setting long-term targets, or tactical allocation, trying to capitalize on short-term mispricing.
Or dynamic,
Like-
adjusting frequently.
Exactly. Dynamic models adjust weights based on incoming signals. There's also risk parity, which tries to make each asset contribute equally to the portfolio's overall risk. The quant models run the numbers, optimize the weights based on forecasts, risk estimates, and the chosen methodology.
Right. This is where it gets really tangible. We can apply this whole framework to what's supposedly happening around Q2 2025, according to the sources. This twist steepening yield curve and easing U.S.-China trade relations. First off, what exactly is a twist steepening?
Okay, so twist steepening means long-term interest rates are going up, but short-term rates are actually falling.
That sounds contradictory.
It sends mixed signals, definitely. Rising long rates usually suggest markets expect better growth or maybe higher inflation ahead. But falling short rates can mean the market thinks the central bank might have to cut rates soon, maybe because of near-term economic worries.
So Optimism about the future, but maybe some caution about right now. Plus, this backdrop of better U.S.-China relations adding another layer. How does a systematic investor, using the kind of framework we've discussed, approach this specific scenario?
Well, based on that framework, especially the kind of sector sensitivity analysis we talked about, this environment points towards certain sectors potentially doing better.
Like which ones?
Cyclical sectors, often to value stocks too, tend to benefit from better growth hopes and easing trade. Think energy, materials, industrials. For them, the positive growth signal from trade might outweigh the headwind from rising long rates.
Okay.
Energy and materials also often do well when inflation expectations pick up, which rising long rates can imply.
What about financials? Don't they usually like a steeper yield curve?
They do, but it's a bit nuanced here, according to the analysis. Big banks might benefit from the steeper curve overall and the growth outlook, but smaller regional banks could get squeezed if falling short-term rates hurt their lending margins. So not uniform across the board.
Interesting. And tech. Rising rates usually hurt growth stocks.
Generally, yes, because future profits get discounted more heavily. But again, nuances. Specific subsectors, maybe in hardware or productivity tools, could actually benefit from more corporate spending if trade tensions ease and growth picks up.
Okay, so who might struggle in this environment?
The sectors most sensitive to rising interest rates are the obvious candidates. Utilities, real estate. Their steady dividends look less appealing when bond yields rise.
Right. Competition for income.
Exactly. And defensive areas like consumer staples often lag when growth prospects improve and inflation might be ticking up. People rotate out of safety and into growth.
And the broader growth tech space, despite some pockets doing well, could still face headwinds from those rising long rates.
Yeah, that discounting effect is real, though maybe partly offset by the better growth picture compared to a situation where rates rise without any trade improvement.
So for the systematic investor, this isn't just a story. It's about turning these insights into actual portfolio moves based on model signals.
Precisely. It means dynamic sector rotation systematically adding to the cyclicals, reducing the rate-sensitive and defensive exposures based on how strong the signals are from your models.
Maybe even trading within sectors?
Could be, like a barbell in tech, maybe long the trade-sensitive hardware, short the rate-sensitive software. And derivatives would likely be used for fine-tuning.
Like specific currency bets related to trade, or direct plays on interest rates.
Exactly, gaining targeted exposures that way.
It really highlights the need for a robust quantitative process to navigate such a complex picture.
Absolutely. You need models to identify the regime, templates for how to allocate in that regime, and clear rules-based systems to make the adjustments. Derivatives become tools for precision.
Measuring success here, backtesting these global macro strategies, it sounds like it has its own set of headaches.
Oh, it does. Big challenges. Just getting good, clean historical data for everything globally, stocks, bonds, currencies, commodities, back far enough is tough.
Right.
Then you absolutely have to factor in realistic costs, trading costs, slippage, market impact. Ignoring those gives you fantasy results.
And the point-in-time data thing again?
Non-negotiable.
Yeah.
You have to avoid look-ahead bias religiously, and crucially, test across different economic regimes. As we keep saying, performance is so regime dependent. Even that sector study replication faced issues like using ETFs as proxies and being careful about data versions.
So, proper backtesting is a serious undertaking. What metrics matter most when evaluating performance beyond just the average return?
You need risk-adjusted numbers,
Right.
like Sharpe ratio, Sortino ratio. You look hard at the downside maximum drawdown volatility. Critically, you analyze regime-specific performance. How did it do in expansions versus contractions?
Makes sense.
You compare against benchmarks, obviously. And use factor attribution to see what drove the returns. Was it the macro calls? The
Yeah.
factors, currency bets. Interestingly, some research, like that Harvey study, actually found systematic macro funds historically had slightly better risk-adjusted performance than discretionary ones.
That's a key finding, bringing us back to systematic versus discretionary. That study suggests systematic might even have a slight edge, risk-adjusted.
Yeah, that research bolsters the case for systematic. Less bias, consistency, data processing power, finding small edges, transparency. But again, it doesn't erase the discretionary strengths we talked about, flexibility in crises, handling the truly novel qualitative insights, especially in geopolitics.
So it's not necessarily that one is definitively better. Is the trend more towards combining them?
That definitely seems to be the direction. Less either, more how can we use both? You often see humans setting the big picture views, the investment themes.
Strategic direction.
Exactly. But the execution, the day-to-day trading, the portfolio adjustments that follows a disciplined, systematic process. It's trying to get the best of both worlds. Human insight plus quantitative rigor.
Let's drill down on a specific way. The sources suggest systematic investors can generate alpha, these cross-asset relative value trades.
Yeah, these are interesting because they aren't just bets on the market going up. The core idea is you find assets that usually move together in a predictable way.
They have an equilibrium relationship.
Right. Then you watch for times when they temporarily diverge from that relationship. One looks cheap relative to the other. You go long the cheap one, short the expensive one.
And wait for them to snap back together.
Exactly. You profit from the relationship reverting to normal.
And the current environment we discussed, the twist steepening, the trade easing, creates specific opportunities for this based on those quantitative relationships identified in the research.
It seems so. Based on those empirical findings, you could set up trades. For example, sector relative value based on yield curve sensitivity.
Like long financials, short utilities based on the study's findings.
Potentially, yes, if the quantitative work shows those differential sensitivities strongly enough. Or cross-regional relative value based on trade exposure, long assets in regions expected to benefit most from easing U.S.-China friction, short assets in less affected regions.
Even within sectors?
Yeah, intersector relative value. Maybe in tech, long door makers potentially boosted by trade, short the software firms more hurt by rising rates. The empirical research provides the quantitative map to find these potential mispricings driven by the current macro factors.
So the systematic analysis identifies the potential pairs and the trigger points.
Precisely. It gives you a data-driven basis for these kinds of relative bets.
And you mentioned machine learning earlier. Could that help here too?
Potentially. ML might be able to spot more complex, non-linear relationships that simpler models miss, possibly uncovering more relative value opportunities or other alpha sources. It's definitely an area people are exploring.
Looking forward then, where is systematic global macro heading? What are researchers working on next?
Well, the sources hint at a few things. Getting smarter about classifying economic regimes, maybe using ML or clustering, instead of just simple rules.
More dynamic regime identification.
Right. Also, tapping into alternative data sources, satellite imagery, credit card data, web scraping beyond the official economic releases.
Finding new predictive signals.
Exactly. And just continuing to refine how you blend those macro views with the traditional style factors like value and momentum into more unified, seamless strategies.
Wow, okay. We have covered a lot of ground. We started with defining global macro, that contrast between discretionary intuition and systematic data-driven approaches.
Then we dug into the tools, the big economic models, the econometric techniques like ARIMA, GARCH, VR, and how factor investing fits in, but crucially, only when you understand the economic regime.
Right. Regime dependency is key. We looked at portfolio construction, the importance of diversification, hedging, and how quantitative models help put it all together.
And we applied it. We took the current scenario, the twist deepening curve, the easing trade tensions, and used the framework from the sources to think about which sectors might win or lose.
Showing how the quantitative findings can lead to specific portfolio tilts or relative value trades. We also touched on the big challenges in backtesting realistically.
It really underscores that systematic macro is this complex, data-hungry field, but potentially a very structured way to navigate these global markets. Understanding the macro factors and the prevailing economic regime seems absolutely vital.
Yeah, it feels like the real art or science is translating those macro views into effective systematic strategies, maybe increasingly by blending that systematic rigor with human oversight.
Which leaves us with a pretty big question, doesn't it? As data keeps exploding and AI gets smarter, just how much more of the complexity of global macro can these systematic approaches capture? And, what's the truly essential lasting role for human judgment and intuition in this increasingly quantitative landscape?
A fascinating thought to end on. Thanks for walking us through all of that.
My pleasure.